Alrighty. Oop. Yeah, we are up. We're live. That's it. There we are. Alrighty. Doc here from North America. Good morning, good afternoon, and good evening. It is TGIF. It's the last Friday of the year. That's what it comes down to. The last Friday of the year. It'll be very interesting to see how it all plays out. What do we got here? We don't have the charts up. Let's get that chart up at the same time. Let's see, where's that at? Like that. There we are. And let's get that thing. I keep on hearing a ding, and I can't figure out where it's coming from. Let's see if we can figure that out. There's the dollar index. Where the hell is that ding coming from? I keep on getting a signal like someone's trying to communicate with me, and it doesn't seem to. Where is it? Maybe that's it. Let's try this. Try it on a separate machine. Maybe there's something else will spit out. We'll find it in a second. Could it be? It's not there. I don't see it. Anyhow, and I see Robin is up on the. It says hello trader, so it's not me or him. Not sure why we keep on hearing things, but we'll keep on looking to see if we can figure it out. So this is the last Friday of the month and the year. And Wednesday is the first of the new year. It'll be interesting. So we have Thursday and Friday of next year's trading occurring right around the corner. I've heard people, different fund managers say different things. Looking for a 10% correction, and then second and third and fourth quarters will be very strong. And I'm thinking to myself, why would a money manager? I guess they could say it may. I have a hard time believing a 10% correction would occur, but you never know. Obviously, we just saw a. I guess we could put it up on the screen. Let's see if we can put it up on the screen. We saw a big drop in the equity market. Now we were just looking at the. Let's just go back real quick. What we're over the dollar index. Where's that dollar index again? Let's go back to that, and then we'll go take a look at a stock, the S&P 500, as like the perfect description of the stock market, I guess you could say, or a very good tool. Now you can see here, in October, from September, we saw the dollar, move up from par to 108. Okay, so what's that? Like, an 8% increase in the dollar's value. Okay, now that's 8%, not 10%, but that's an 8% move. Now let's take a look at. Let's see, exit that, and let's go look at the S&P 500. Right there, there we go. And look at the same thing over the same time period. And what we saw was the S&P. Went from the, let's see, where is it at? Let's see if we can get this right there. Basically from the 5,700 area, it traded as high as 6,000, it was 200 on the futures contract, but it says 6,101. And then it dropped, just in a 3-day period, it dropped from 6,000, basically 6,075, down to 5,800. Okay, so what is that? That's about a 5.5-6% drop. So they're thinking that it could drop 10%. All right, and there's that's that move from the 5,700 up to there. In other words, 5% on 1,000 is 50. Okay, and 10% would be 100. So in other words, if you drop 10%, you're talking 600 points, and that would be down into the 5,600 area, basically, something like that. Markets and you can see we've had some really quick jumps. Here's right after the election. It went from 5,700 up to 6. That's about a 4% move. 5% move right there. markets like to anticipate the future. I have a hard time believing they're going to let too many people in, especially with all the cash that's out there, all the demand. The American market is so much more stronger than what it used to be compared to the rest of the world. Okay, in other words, it's one of those Al Einstein things, relative. We see Europe doing fair. Let's put up the DAX. Let me make sure no one's asking me any questions on the chat line too. Okay, there it is right there. There we go. And so let's take a look at the DAX and see what the action was in the DAX when the S&Ps went from 5,700 to basically 6,100 over a very short period of time, days, weeks. Let's go take a look at. Let's see, bring that back to there. And how does this relate to the dollar? Well, obviously they want to be. If you own U.S. stocks, you're long the dollar. And so in many ways, if you want to be long the stocks but short the dollar, you got to short, the pairs trade of your country. And so that jumps out at me instantly. And so if you want to be long dollars and U.S. stocks, then you don't hedge your currency bet. That's pretty much what it comes down to. Now let's take a look at, here is the DAX over the same time period. And the DAX was trading at, 19, there's the low, basically 18,911. So let's call that 18,900. Okay, and it has traded as high as 20,000. Let's just double check that again. There it is right there. So it's not 18,900. And is that 20? Yes, that's 20. So it's moved up about 4 or 5%, from that situation. And then from the November election situation, there's the November thing, it rallied pretty decently going into the 5th there. You saw some wild movement, though, slammed it down, went down a little bit for about a week or a couple of weeks, and then turned around again and roared from the 19,000 to the 20,000. So that's a 5% move. That's even better than a 5%. It's almost a 6% move. Do I expect this? And you can see the sell-off here, too, was a very small one over these last couple of weeks. It doesn't look anything like this pattern. Doesn't look like anything compared to, let's put the, I guess does it match up? It doesn't match up to the Dow. The Dow went sliding down, which was very interesting. But the S&P 500, which is basically the broadest view of, I guess you could say the world stock market, because the S&P 500 has half its companies are foreign investment. In other words, there are other companies in other countries. So only 50% of the stocks in the 500, the 250 of them, are American, and the other 250 are global. So you can see here some of this wild swinging, and here we are, basically sitting right back up to the all-time highs again for a 3-day period. Not even 2-day period gap. Boom, zoom. So and then we can go back to the Federal Reserve. Another story. Can you believe it? Every time you turn around, there's a Federal Reserve story. It's not very pretty. It makes them look very incompetent. Now, remember, back in the summer, they reduced employment by 800,000 employees. In other words, people were all of a sudden, they weren't in the workforce. We lost 800,000 workers out of nowhere. Boom, gone. Now they turned around yesterday after the webinar, and another 700,000 are wiped out of the workforce in a day. Gone. They don't exist. In other words, they were fictitious numbers. They were fake numbers. So you got 1.5 million employees supposedly working in the United States that all of a sudden don't exist. It's like, what is going on with this Federal Reserve? Just when you think that they might finally get a grip on financial reality, they turn around again and tell us, oh, we were wrong. That 700,000, and it was like 717,000 or 16,000, something like that, doesn't exist either. They're not really there. So just let's reduce. But every month they put out an employment number that's always better than the month before. And then I guess it builds up over a 4-year period. And you find out that under Mr. Biden, they lost jobs. And here we are, the last 23 days. What's today's date? Today's the 27th. So 4 and 20 is 24. 24 days before Mr. Biden is not the president anymore. 24 days. You know, they did it over late August going into September, and now they've done it again. And that was for year over year when they took out the 800,000 workers out of the workforce. That gone. They don't exist. It was a fake number. Now they turn around and flatten it out even more. Another 700 and some odd thousand in the last quarter. So they didn't want to tell everybody it was one. In other words, everything's been done politically by the Federal Reserve to make the existing government look like they're efficient and productive, when in fact, the Fed keeps on generating fake numbers. I mean, that's going to be the title today again, and it's absurd. It's like, come on, guys, just give us the real numbers. And if the government is not functioning, aren't you supposed to be politically independent? No. The Fed is not even remotely close physically independent. And I think I mentioned it yesterday or the day before. 9 out of 10 people who work at the Federal Reserve donate money to the Democrat Party. 9 out of 10 actually take money out of their pocket and send it to the Democrat Party for politics. I just had to sip my tea after that one. Just had to. And you just want to scratch your head and you just want to say, are you for real? Why do we even have a Federal Reserve? Maybe it should be a currency board. Get rid of it, and they can float notes if they want to float notes for the government, but let the Treasury do its job. Really. Let the Treasury do its job. I mean, this has only been a way to feed politicians, and I'm probably telling you something that, this is a global webinar. This is DocDow, Switzerland, Latvia, Ukraine, so forth around the world, Bulgaria, Romania, so forth and so on. We have people we've talked to on here from New Zealand and, Singapore and Thailand. This is a webinar that kind of reaches out because of DocDow being a global brokerage house. And all of you should wonder how much your central bank is more political than it is economically viable. In other words, actually telling you true data. I've told you how under Mr. Obama, it's almost impossible for the unemployment number to go up. He changed the numbers in it so badly and so twisted politically that it's hard. So in other words, the Federal Reserve now is always, we have unemployment working out really great. Yeah, sure. And here they've just wiped out 1.5 million employees over a year and over the last 3 months or 4 months. Let's see. We're in December. So January is 5 months ago or 4 months ago. It's 5 months ago, right? So December and November, October and September. Okay, so they wiped out all those jobs between the beginning of September over 4 months and yesterday. They've taken 1.5 million people out of the workforce that don't exist. That's a big number. That's a 1 or 2%. Matter of fact, the GDP, the gross domestic product, is now considered it's minus. So our GDP is matching Europe because obviously, our Democrats love this socialism and they want to be Eurocentric instead. And so they have this hunger all the time. They want trains and they want socialism. They want it over and over and over again. And our system's not designed for socialism. It's designed for capitalism. And obviously that's why we dominate the planet, financially, militarily, technologically, it's because our capitalists still have a chance to participate, whereas the capitalists in a lot of other countries are parked to the side and not given an opportunity to participate anymore. So that is pretty much the end of the story and the beginning of the story right there. All right. And so I think I'm going to automatically, with only 15 minutes into the webinar, we're going to relabel this. I see. There's another ding. What's all this ding stuff? All right, let's see. Let's see. Not now. What the hell? What is this? I keep on getting pounded by noise, like as if somebody's trying to communicate with me. All right, so let's go to. Oh, I see what happened. Aha! The software downloaded last night, so now I got to go turn everything off. That's what it comes down to. Yeah. Advertisement. So the title today. And that is central banks are only political. I think the Fed and all central banks are political. That's exactly what it is. Fed and central banks play politics. That's all it is. That's exactly the problem. And so, money managers, as much as I make a joke about a lot of them, and they don't outperform the S&P 500 and so forth, they don't outperform their benchmark. What it really comes down to, they have to follow some basic mechanics to survive. They have to look at earnings and cash flow and EBITDA and DIBIDA and all that other stuff. I mean, remember, EBITDA is actually a thing. It's it's like earnings before taxes and inflation or something like that, and it's the same thing with DIBIDA. It basically, what they've done is they've had to twist. The actual fundamentals, and Janos, who used to work here, had a couple webinars on how to trade the markets today in the QE era. And QE is just a tool that should have been turned off 2 years after it was started, which is fine. Put it back on the shelf and wait for the next disaster. Instead, here we are to this day. Here it is. The year is December 27th of 2024. They started using QE at the beginning of Mr. Obama's election, in I guess it was like October, right as he was ahead in the polls, and they were having financial problems from the Democrat committees. They created problems. Bryony Frank, actually retired because of it. He was one of the lead Democrats that buried the the world. Saw him crying with Maria Bartiromo on TV. Used to have that video. YouTube has found a way to get rid of it. You can't find it anymore. Where he's crying, saying, "We thought we were doing the right thing. We thought we were." Yeah, you bankrupted the planet. Lloyd's of London is gone. Merrill Lynch is gone. Lehman's gone. Bear Stearns is gone. I could keep on going all day long. HSBC is gone. Bank of Scotland is gone. All they are is names owned by central banks. And, Deutsche Bank, gone. No one would even buy the thing for $1 or €1. They couldn't even sell the thing for €1 to anybody. It was so bad. So the central bank in Germany controls it at this point. So that's the end of that story. We'll go back to looking at everything else, but I don't understand why people would think that the money managers would think that they're going to get a chance to get a 10% discount on stocks. If we really are going to get the economy we had under Mr. Trump, who wants to sell their position? Just sell calls. Go into the options market, sell calls, buy puts, and sit there and let them take your call out. Basically, and you'll get more money than what you paid for the stock, and you'll be collecting dividends at the same time. It's like a synthetic bond and an equity enhancer. You can always roll that call further out and keep on making more money. So, to me, I don't understand the call, or let's put it this way: the desire to think that we're going to see a 10% correction. You've seen what happened when every time they spiked it down, they've gone and moved it back up real quick, because there's so much capital sitting on the sidelines because so much capital has been created. Matter of fact, that's one of the wacko things that the central banks have been doing, and the Federal Reserve, is that they've been lending enormous amounts of money to banks and then forcing them to keep it in a savings account, not lend it to to people who come to the bank and say, I want to open up a laundromat, or they want to open up a gas station, or they want to open up some type of business to manufacture apples or oranges or whatever. In other words, there's cookies or shirts. They're not lending that money to the public. What they're doing is they're keeping it all pumped up inside the central bank system. And so there's so much cash floating around. That's why in the QE era, we saw interest rates go minus. That was the reason why. Is they were afraid to put their money anywhere else, and they weren't allowed to put their money anywhere else. That was the weirdest part. All right, so for the last Friday of this year of 2024, we're being awoken again from the level of irresponsibility of the central banks. Can't I just talk about markets? Honestly, can't we just talk about markets in general and earnings and, GDP? You can't, because they fudge these numbers all the time. So in other words, the American GDP is probably in a minus. And if we're in a minus, no wonder we showed it to you 2 days ago, why China is trying to float 3 trillion yuan in bonds. They've never floated more than 1 trillion bonds a year. That's the most they've ever done, is 1 trillion yuan in the bond market. This year, they're trying to find ways to stimulate their economy and create a QE, a quantitative easing. And so they're up to about 6 trillion yuan now if they float the bonds, which they will. And they've taken 1.4 trillion yuan out of their savings account, which is about $150 billion. And now they're doing a 3-year plan. The Communist Party has decided to add another 1.4 trillion yuan. So you've got, you're basically looking at 6 trillion yuan to stimulate an economy that I keep on telling you, the math says needs to be between 25 and 30 trillion yuan. So China is so underwater, they can't even borrow enough money to stimulate their economy. They don't have the cash flow. That's what it comes down to. They don't have the free cash flow. So, anyhow, that's my, how many minutes was it? It's a 25-minute rift on the central banks in this planet just playing political games. That's all they're doing. Trying to keep the same people in power all the time. It's time to change that. Term limits for everybody. All right, now from there, where are we going to go to? Let's jump over to, let's go back to the dollar index. And what we'll do is we'll take a look at the dollar index, where it's at, and then we'll take a look at the bonds again. We've been showing you that, the central banks have lowered the official rate from 5.25 down to 4.25, and the bond market has raised the price out there in the market to 4 5/8. So it's 3/8 over the official rate now. When they started this, let me just show it to you. Let me just get it up on the screen here for you. Let's just go right to the bond market. See if they're doing, since the dollar index is dropping a little bit, maybe the interest rates have dropped a little bit today. We'll see. Let's take a look at the 10-year bond. Right there. There's the 10-year bond. Well, you can see the algorithm right there is trying to lift up. We're still in a weekly sell for 3 weeks. And you can see here the price of the bond is closed a little. It's trading a little bit lower than where it's settled, but higher than its low right there. So yesterday we showed you, what did we show you yesterday? Let's do this. Yesterday we showed you that the bond was yielding, was it 4.63. So let's see where it's at today. It was 4.63 on the 10-year. Here it is today. Well, there it is. It's showing to you. Nope. Let's go fix that again. Let's see. There's the 10-year now, right there, yielding 4.60. Okay, so it's dropped three bips. Three tenths, I guess you could say. So it was at 4.635 yesterday. You see that up there? Oh, that's that's kind of like that. It was at 6.3 yesterday. It traded that high. Let's see if we can find it. Yeah, it traded as high as you see that right there yesterday. 4.6410. It's the high. See that box there? That was the high yesterday, but they brought it. They lifted, they bounced and settled at 4. They settled at 4.579. And then why did that happen so fast? Because they reminded the world that now we have 1.5 million less people working in the workforce within basically 24 hours. Gone, like smoke in the air. All of a sudden they're there and then they're not there anymore. And the GDP in the United States, that makes the GDP a minus. So right now our gross domestic product is a minus. And how did they hold that up for 4 years pretending? Because the central banks in our world are all political. That's what the problem is. All right, now let's go back over to, what we can do is we can just go directly to the euro, and let's see what the euro is up to this morning. We showed you what the DAX was doing, and we could show you what the FTSE's doing before we go running over to the currency. Let's take a little look around what the stock markets themselves are doing, and when you really think about it, it's really fascinating, and that is the China. No wonder that people want to talk about how great China is doing, and it's just having a little hiccup. It's 50% off its all-time high. 50, not 5%. Whereas a lot of these indexes are 3 and 4%, if not less. They're at the all-time high. The S&P 500 is inches away from the all-time high. Yesterday they had the Russell 2000, not the Russell. I'm sorry. They had the Tech 100 at only 400 points or less than what was that? Less than 2% at near its all-time high. I mean, these things are cruising along. Now you can see here they've been taking the FTSE down. Maybe because of the politics. Obviously because of the politics. In other words, we're seeing situations like that, and now it's a perfect example. The Exchequer has been a disaster. The Exchequer in England, their central bank, has blocked any capitalism. They keep on blocking capitalism. They want socialism. That's all they do over and over today. It doesn't work. If it worked, the CCP, the Chinese Communist Party, would be ruling the world by now. They have love and desire to do so. The Soviet Union would still be here. There is no Soviet Union anymore. It's all gone. And, it goes that way around the planet. They try to move. They try to control. They try to, decide how you and I live every day. They want you to do what they tell you to do. So there it is right there. That's the FTSE. And obviously, that's all-time highs right up in here. I mean, it's not that far off. You're talking about, 8,400 basically. What's that one? There's a 8,388. This one right there is 8,395. That's the all-time high. And here we are right now, at 8,000. So basically, you're only talking about 400 points. 400 points in an 8,000 index. Let's put it this way: 10% would be 800 points. So it's like 4% down. That's it. Whereas when we go and look at, let's exit the full screen, and let's just show you a good example of. Let's go like this. We'll go over to here and take a look at the only way we can measure the economy, is through the stock values and inflation and GDP, and they fudge these numbers on us, so we don't have much of a choice. We have to, as money managers and traders, you have to look at these numbers and say, okay, what have you done for me lately? Basically that's what it comes down to. And so here is the yuan. We'll show you where the yuan is right now. The Shanghai index. Sorry about that, not the yuan, the Shanghai index, because the yuan is just fixed to the dollar, so there's not much you can do with that. You can't measure it much more than whatever the central whatever they call it office controls the price every day. They set a price, but we can go like this. They can't set a price for, what the hell? There it is. There we go. There it comes. There it is right there. There was an up day today. Nice. And yesterday was an up day. So they're buying into the end of the year. So it's at 3,400. Now, let's go take a look at it over the last 5 years. Not bad. And then we'll go back to the quantitative easing era. And there it is right there. You see the all-time high is 6,124. And we're trading at 3,400. So we're just around 48% off the all-time high. 48%, not 4%. Not like the FTSE or the DAX or the S&P 500 or the Tech 100. They're just cruising along, and you can see it's been a massive triangle, basically. And that's when quantitative easing started right in here. And right there, there's your quantitative easing, and they had to try to save the world. And what have they done? They've put it basically to sleep. It's sleeping, like Sleeping Beauty, waiting for the kiss. All right, so let's go take a look at the euro. We'll take individual currencies unless someone wants to see something in particular. There it is right there. And you can see a little strength, just like we're seeing a little weakness in the euro. In that case here, you see it's trying to lift up. It's been in a daily. Let's see what's up with this. Let's do this. Went into the buy right. Into the buy right there. So it's been in the buy for 4 days. Let's scroll down to the spreadsheet. Scroll up to the spreadsheet. 3 full days in a buy. 13 weeks in a sell. We're very close to getting into the weekly buy. It's the end of the year. They're probably, remember taxes? Again, government sucking up money. Taxes. Tax, you got to adjust for the end of the year. You got to mix your losses with your gains. You got to sell things that are good so that you can take profits, and then you got to sell things you've lost money in so that you can offset those profits so you don't pay taxes. It's again, the government will take, but it does not giveth. Sip of my tea. When it does giveth, it's giveth to its friends, not everybody. It's discriminating. It only giveth to its friends and its other fellow politicians. And so there is the I guess we should put a green in there. Wow, look how, I was looking at oil this morning. Oil looks the same way with the way this daily does. It always amazes me. Let me just go show you oil. I've been laughing at they cannot get the oil market flattened out. Look at that. Weekly in, weekly out, weekly in, weekly out. I mean, look at that. For months now, they've been, in and out, in and out, in and out, sideways, just like a lot of products. They don't know where to go, when to go, and why to go. Our math picks up on it pretty well, though. Thank goodness. Like the daily picks up. The weekly won't let you be long, and you can't be short. Keeps you neutral most of the time, unless you're a producer, and then you can use the daily every day because you're long. If you're a producer of a product, no matter what it is, oil, gold, whatever, oranges, if you're a producer of it, you're long. So naturally, you can hedge the long and adjust it day in and day out. That's how you use that. Now, how did I get a commercial in the middle of this out of nowhere? There we go. So there is the Feb crude. We'll go back to the energy sector, but we were looking at the currencies, and you can see here, look at all those ins and outs. So in other words, it's been in a weekly sell since the 112-ish, 111.75 area, that type of thing up in here. And it's found a way to find itself down into the 103.5 area, just like the dollar index doing the opposite story. Because the dollar index has 53% of the dollar index is the euro. And then it's the next one biggest in there is the second most active currency in the world. That's the yen. Then the third most active currency in the world, which is the British pound. The fourth most active currency in the world is the Canadian dollar. Then we go into the Swiss and the kroner for the last two. It's only 6 products in the dollar index. And we can say that the because of China's hunger for cash, they're getting into the 5 and 6% area. They're as active now as the kroner or the Swiss franc. They are, they're becoming more and more active because they need cash, because they've taken everything they made from the United States and just built their military up, thinking that they're going to go to another World War III of some form. Obviously, that's not going to be a winner chicken dinner. No one wins in a World War III, so I'm not sure these people who are running China are relatively clueless. Let's see. Let's go to, what are we heading for on this currency? Let's take a look at the cable, I guess. I must have suggested something I was going to look at. You see the cable's going through that same situation. The cable, since October. Let's see if we can. I know. I was going to look at the dollar index and compare it to. Let me just do that real quick. The dollar index to the euro. That's what we were heading for. There's just so much. There's so much wrong going on in our markets, and one thing is for sure. You can see it here. There is the dollar index being, as it went into the, and you can see it on the spreadsheet too, I would imagine. Let's see. There it is right there. 12 weeks in a buy, and there's the euro, 13 weeks in a sell. Cable's 12 weeks in a sell also. So, matching up to the opposite side of that. So it's the same story there. All right, now back to the currencies. Back to the future. So there it is right there. Cable went into that weekly sell up in the 130-ish area. 134-ish area, 133 area, something like that right in here. And fell all the way down to 125, basically. 124.87. So, and same thing there. Played the 124s again. Almost 125. The higher end of that 124. And trying to dig its heels in. We're getting closer and closer. You can see our zero line right there. Very, very close. And again, unfortunately, traders, because of taxes, not counting fake numbers from our central banks and the Federal Reserve, there's not much room for them to do much more than what they're doing now, and that is going, sideways, down. We'll see. We'll see how this. So we're going to see that. Wow, this is amazing. They're advertising something on one of the financial channels. about Mr. Trump. It is amazing. We've only had now a second president that actually lost the election and then came back and won an election right afterwards. And for some reason, as much as they keep on saying that the election he lost wasn't rigged, somehow or another, the Democrats lost 15 million votes. Just like our, isn't that funny? 15 million and 1.5 million fake jobs. And obviously we had 15 million fake votes. Because Mr. Trump got the same number as last time. He got about 77 million votes, just like he did 4 years ago. And somehow or another, the opposition got something like 83 million. And then this time, they only got 67 million. So it's like, I mean, talk about, they usually say criminals will repeat their activity. So 1.5 million jobs missing, 15 million votes missing. They just fake everything, don't they? All right. Let's take a look at the inflation fighters, the Swiss. You can see it's still banging against the top end of that range we identified about a month ago when we started the blue dots, And it went down first and once it broke through there, we set the new range, and that was those purple dots. And you can see here we're just banging against the top end, and we talked about it. We didn't really think this thing's going to get much further. But again, since we're at the last Friday of the month, and we got taxes to deal with as traders, when you have profits, you have to try to offset. Taxes alone will steal money from you, and mess up the loss and gain situation. So taxes are so bad. They're so wrong. Government should be not taking money from us. Government's supposed to be there to help us, not hurt us. All right, there's the yen. And there's the yen playing above its range we've talked about. It bounced about the bottom just once. It touched it. That was it. And then it ran up and touched the top and fell back to, I guess that's about a 0.38 drop. If we Fibonacci that, let's see what happens when we Fibonacci it. It's always neat. Our math is ahead of the Fibonacci sequence, which is always amazing. Blows my mind every day, since the Fibonacci sequence is something that's universal. So there is the 0.38. Now, almost got down to the 50 percentile. Notice it closed at the 0.38. And so if we revert, see there's the 3.8 right there. There's the 618. So if we go like this, we erase that, remove, and we start it from, I guess, the bottom up. Is that what we do? We go bottom up. So we go like that. Will that do it? Yeah, there it is. So it played with the 3.8 right there. There's your 3.8 right there. You are seeing that. Yeah, you are seeing that. And so it played with that. In the close, it went below it at times during each of those days, but it tried to almost close right on it each day. And now what we've done is we've jumped across. And I guess we could redefine the range again, but you know what? We're going to let the tax season end, which ends next Tuesday, and then we'll readjust we'll show you. Next Tuesday, tune in and we'll show you. No, I guess it will be between Tuesday or Thursday. I will show you how we set these ranges ahead of time. Yeah, not during it. We can show you how to set these ranges ahead of time. All right, and so there is the yen at the top end of its range. You can see it on the spreadsheet right there. 2 weeks in a buy, 16 days in a buy. I saw something. What do we have on there? Check this out. Look at Apple. 30 days in a daily buy and 5 weeks in a weekly buy. Let's go just take, it's Friday, last Friday of the year. Let's just take a look at Apple. Let's put Apple up on the screen. I think that's wild. 30 days in a buy, 5 days in a buy. Yesterday it broke another all-time high, I think it was. This will be Netflix, not Netflix, Tesla, because that's the last thing I watch on that page. And then there it is right there. So we've been in a weekly buy since right there. Let's throw the line in it. No one's looking at it through our math. Anybody that's watching it is watching it through our beta. I think that's it right there. So it's been in a weekly buy since there. It's going to be the 6th week. And there is the all-time high. It's been in a daily buy since, basically right there. Is it that one? No, it's that one. So let's throw a line in there. Don't have to put a second line in there. And we had a red and green dot on this one right there. I think that's what it was at the time. They seem to have changed it, but I'm not paying attention at this point. It's just been in that long, especially with it being in a weekly buy. You can't, get shorted, that's for sure, because you're in a weekly buy since, back in here. I don't know. I just thought it would be fun. 30 days in a buy. That's what the spreadsheet's all about. And we send those out to you free if you want it. Let's see. That's a record every day. It's nice to send it to the most amount of people possible, solely because it just shows you for the last 50 years what our track record is over and over again. We send it out for decades upon decades. All right. So from there, there we go. Let's go back to the currency, and let's take a look at the Great Experiment. There it is right there, the Great Experiment, Euro Turkish Lira. Oh, wouldn't it be great if the Turkish Lira would just fall asleep like that now for the next 10 years? Just stay there. And then the economy could catch up if they had a capitalist system. Unfortunately, they're more socialist, so that's why we have so many Turks in the United States now. They're running away from the place. But you can see it's bouncing off of some range that we've identified. You see it fell down from, I guess if we tighten this up more, you'll see the range we developed. We had that range before it hit it. That's the important thing here. That was we set the range. When we created that range, it was right there we set the range that day. So you can see that's why it's neat when we have boxes up there. You can go back and look and see ahead of time where we set the range. It ran up to it, hit it, it broke through it this time right there, a few months later, but became the support. Remember, it closed there that day as much as they panicked and messed up somebody's profit and loss, that's for sure. But that's the way it trades wild like that once in a while, because it trades at like 35, 40 volatility. Yeah, that's where it's, can you imagine? I mean, you're looking at like, let's just show you the VIX. I mean, the VIX has jumped. The VIX is the S&P 500, and you can see it jumped from 15 to 20, like 27 one day when the S&P went crashing down. But overall, the VIX stays in a relatively tight range, minus any excitement. You can see that when what was that, back in August? I think that was when they changed the. We lost 800,000 jobs. I think that's what that was. It was like, we did what? What do you mean there's 800,000 jobs less? And that automatically puts a crimp into the GDP, because the GDP is 22% or 23% of the employment number is 23% of the GDP. And then obviously it influences the CPI and the PPI. In other words, it's not a good thing to watch us lose 800,000 jobs out of nowhere. Boom. They just declare it. And you can see the front running. Someone knew it was coming a couple days ahead of time. So the Federal Reserve obviously was front running it. We jumped into the buy there, and the VIX exploded up to there. And that's usually what happens. Insiders come in and they did the same thing here. You see, we were in a daily buy right there, and then someone knew a couple days ahead of time that they were going to pull another 700,000 out. In this case here, there's yesterday, the VIX didn't even move from it because they already knew it and adjusted for it, and that's what that was all about. So let's go back to now. This is volatility. We're showing you this because of the 15 versus this case here. The volatility blew up to 60, and then woke right up and got straightened out. Within the next day, was back down into the 20s. That's why the VIX options are European options. They're not American options. So in other words, you can't exercise the options. Where an American option, you can exercise. You don't have to worry about it as much. You can outlast the insanity. Now let's go back to the currency. We'll look at the Turkish lira. And so this has been cruising between 35 and 40% in volatility every day. So even with it down in here, it's in the low 30s. The volatility might be 34 today. I could hunt it down. The central bank of Turkey, posts it every day. And you can see it's just kind of cruising around in the 30s, and I'm sure it jumped up into the 50s or 60s with that move there, and then it straightened out again. From there, and look at that. We're going to go into the. Looks like we're going to definitely go into the weekly buy. So a lot of this could have been, and we've mentioned it. It could be tax. Tax selling starts in the middle of like October, going into definitely November. Tax selling definitely gets involved then. And then what happens, money managers in general usually try to flatten out their gains and losses and then shrink down their activity for the year from October to November. And by December, they're already looking at what to start doing in the first of the year. So money managers, matter of fact, when I used to work for a hedge fund, I used to say to them, why didn't you guys just flatten out? Like in October, you just had 3 great quarters, and now your longs are getting beat up from tax selling. So why do you do that? Why don't you just throw calls on, sell calls against your portfolio, buy puts, stay long, don't incur the expense of execution, and just take it all off in January. And you know what? A lot of the hedge fund industry has paid attention to Doc's idea. And, at that time I was with one of the most renowned hedge fund or money managers in the world from the Oppenheimer funds. So, if I said the name, there were 2 guys that ran the Oppenheimer funds, and I was an associate with one of them and his own personal hedge fund. And it was a small hedge fund back in those days. It was just a couple $1 billion. But, I said that to them. I said, why do you get involved in that? Why do you allow yourself to lose in the fourth quarter when your earnings are based off of earnings? So in other words, you make more money, you get 20% of the profits or 25% of the profits. So why are you giving away a whole quarter for nothing when you can just sell calls and buy puts and go neutral? And it was like, oh, well, the people who invest in our fund expect us to be active 12 months out of the year. I said, you are. You're in the position. You're collecting dividends. And they were like, yeah, I guess you're right. We are. And so today, I don't want to take credit for it, but I can say that I was one of the early people in the hedge fund industry realizing that they need to be basically protected for the fourth quarter. Don't give away half your year because you're too shy. I didn't want to say anything, call it anything else. I want to talk like it's hedge fund. So it's not this year's business, it's next year's business. And it was leaky going into the fourth quarter. And so we really don't want to be strained. Don't want to have that strain of that leak. So what we should do is we should basically become more neutral. That's right. But at the same time, we're collecting dividends. See, I can talk hedge fund. We become more value added. That's what it is. We become more value added. We speak hedge fundese. All right. So from there, we'll go to South Africa and check out what they're doing. And again, it's tax season, guys and gals. And so that's the Swiss. Let's go find the South African Rand right there. And you can see that thing keeps on trying to push up these last couple weeks. At the top end of its range, we set this box right here. So we tighten this up a little bit. Remember, there was a triangle we were following for a long while. this thing here, and then it started to play the bottom end of the triangle. And then we were watching this, and we set up, let's see if we can tighten it up more to see the bottom end of the range. That's when we started that range, and you see now it's made it to that range. And it didn't go down after. That's the problem, is I put that dotted line in there on an angle because it kept on projecting the opposite. Let me see if we can find that bottom end of the range. Come on. I can see it. Let's just move it up. I guess we'll shrink it a second, like that. No, not that. Let's go like this. Oh, I know what it is. How do we tighten this up so you can see the bottom end of the range? You can see the bottom end of the range in the dots, like that, right there. It's just right on the edge, right in here. And so it came down and hit that, and I think we were looking at this line right there. You know, like a rotisserie chicken. Chicken. Is it winner, chicken dinner? So we got a rotisserie thing going on. You can see here it's driven it up. Now we'll have tax season ending, and it's broken through the range. And it's what's funny is it's going after that old triangle that we used to watch a lot, right there. And you're going to see it intersect like that. And that's something. It started to intersect 3 days before it. So, and you can see here it's been in a daily buy for a bunch of days. Went into the daily buy right there on the bottom of it, no less. I think that's why we put the line. Right there. So it's been in a daily buy since right there. It's been in a weekly buy, whew, all the way back since back in here. And let's see what else we got going on. I guess that's about it. So when we look at that, we got about 2 or 3 minutes. We're going to show you gold, silver. We're going to go flash frame. So here's gold, flash frame. Daily buys, weekly sell, silver, weekly sells for months. And daily buy until today, it's trying to go back into the sell. Is gold going back to the sell? No, it's not trying to get it back into the sell. It's down for the day. It's giving up everything it gained yesterday, like $11, $12 or something like that. Copper, the China thing, you know, I mean, it's trying to bounce. They can't even get into the buy. That's still in the sell also for another week. It's next week's business. That's right. Platinum, right there. Platinum is the April platinum now. You can see we got a volatility signal there, green and red, and then zoom up. It went flying, and we've been in that weekly sell since the 1,050 area. Crude oil. Let's go over to. And we'll show you Brent. We'll show you Brent. You know, we showed it yesterday. Brent 4 weeks in a buy. That's pretty impressive. Whereas, you know, West Texas Intermediate normally follows Brent very well, or vice versa, and they're not doing that. Let's do this. Refresh. There it is. And you can see that too. I can see. You can see. We all can see. There's Brent 4 weeks in a buy, and you can see it's a couple days now in a. Was that 4 days in a buy? 4 days in a buy, too. Then we go over to West Texas. Texas Sweet Crude. Right there. And you can see it's only 2 weeks. It's 3 out of 4 weeks. It went into a buy there, then went into a sell, and went back into a buy. Shows the sensitivity. You can see all this selling in here. That's why you saw those red dots too at the same time. They're both there, but we're in buy, so you can't take the short. That's why, you know, again, I don't think this is as much tax, because I think that this is just, you know, the change of politics. Now let's look at the product heating oil. Heating oil is in a buy for a couple weeks. HO, there's HG, there's HO. And there's heating oil. This powers all the planes and the trucks and so forth. And we're a second week in a buy. and we are 4 days in a sell. 4 days, 3 days in a sell. So it's a neutral position. Don't short it. Just it's drifting up. The weekly's telling us it's still drifting up, and it's trying to get into a buy today, but it's just missing it by the hair. And so from there, what we'll do is we'll show you natural gas, and we're out of here. There's natural gas, and that's Jan. No, we went. There's natural gas. We're into the February natural gas. Let's just show you natural gas here. Let's go over to there. Let's go to that and put the natural gas in it right there. There it is. You see it's flirting. Fell into the sell yesterday. It's trying to climb back up. It's just above by 0.0067, and it's going into the second week of a weekly buy with no problem. And then what we'll do is we'll go back to, and we'll go to Spain and take a look at that stock, ENGMC. ENGMC. See what they're doing in Europa this morning. They were closed yesterday. Let's see if they have them open today. There we are. There's Christmas. Christmas Eve. And then there's today. So they're trading today, and we are 3 weeks in a sell. This is a good sign for Europe, meaning that the cost of energy is going down, not up. This is a winner chicken dinner. All right, traders, catch you all on Monday, the last 2 days of the year. So this is Doc from North America saying happy trails to you until we meet again. It'll be Monday. Happy trails to you, to all our Dukascopy friends. So, have a safe and smart weekend, traders, and we will catch you on Monday. And thank goodness it's the end of the week.